Riding the macro wave, what's coming next? I actually want to start with what happened on Friday, Katie.
Okay.
We had Moody's downgrade U.S. sovereign credit rating. There is no single credit agency that has a AAA rating for U.S. credits, and you are seeing a reaction in fixed income. TCW, of course, fixed income focus. 30-year yields are inching back towards 5%. How big of a deal is this, especially because there's so much scrutiny now about the trajectory of the U.S. fiscal situation?
Sure. So thank you for that, Joumanna, and it's such a pleasure to be here. I'm always delighted to be back in Qatar. As was mentioned, I'm the CEO of TCW. We're a global asset management company. As also mentioned, we manage a lot of fixed income. So I feel like we have some good perspective to answer that question. And we've also had the privilege of managing assets on behalf of beneficiaries in this region for 40 years. So moving on to treasury markets, I'll tick through very quickly what happened, kind of why it happened, impact to markets, and how we're positioned, and I'll do it very briefly. So what happened, obviously we got a downgrade. It's not new news, it's the third downgrade to US, it's the last one of the major rating agencies. The first one happened more than a decade ago. But that was announced, as you said, at the end of last week. Why did it happen? I think the most simple way to think about this is looking at the credit of any organization. If you want to maintain your credit rating, it's usually a good idea to have revenues that exceed your expenses and not to alienate your lenders. We did a lot of that in the US, and this is kind of the result of that happening. Just to give context to people, because rates have stayed elevated, the interest burden now in the US, we spend more on that than we do on the military or Medicare. So this is quite a burden. And then to end with, what are the implications? There hasn't been a massive shift in the short end of the funding market. We think that the implications here are that volatility is likely to stay elevated, term premiums likely to stay elevated, and curves will steepen. And then ending with how we're positioned around that at TCW, this is what I would say. When we came into the year, we were a little bit overweight duration at the short end of the curve and our maximum underweight position in credit.
Yeah.
And why was that? It's not because we were geniuses or we foresaw what was going to happen with tariffs. It's actually because we said, even if all these things are true, even if we get animal spirits and we get deregulation and we get tax cuts, markets are already priced for perfection. And that led us to come into the year in both public as well as private markets underweight credit. And then when we got the dislocation, we had our busiest trading day in 50 years and added to our credit positions in both private as well as public markets. And I'll just end by saying, you asked, what happens from here. I do think that risk assets, whether it's equity markets or credit markets, are too complacent, and that the soft data will eventually catch up with hard data, and we should get more opportunities to take advantage of dislocation.
Okay, I'm going to put you on the spot. Would you buy 30-year U.S. yields at 5%?
No, we are underweight the long end of the curve, and we are overweight the short end because our view is that we will have eventually, and it's not a catastrophic, we just think there's going to be a business cycle, and when that happens, the Fed's going to have to cut rates, and they can move the short end of the curve better. So we're overweight slightly the twos and the fives,
yeah,
and underweight the longer end of the curve.
And just on the outlook,
yeah,
you expressed some concern about the trajectory of the U.S. economy. Where do you think the downside risks are going to come from?
I do think that, you've seen, when I say the soft data, just to be specific, we had the worst reading ever second worst reading ever in the history of the U.S. of consumer sentiment. Yeah. The hard data hasn't yet caught up to that. The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment. They're now back to kind of record tights in credit, yeah, and close to record highs in equity markets. And we would just say that's incongruous with the likely data that's coming out. And I just want to go, yeah, back to the fact that for what we do, this creates volatility and should create tremendous opportunity to step back into the market, because the most tested way to create wealth for people long term is to step up and be a liquidity provider when other people can't or won't. And we have a strong view. We did it already in the second week of April, and we just think the market's going to give us more opportunities to do that in private, yeah, and public markets.
The snapback in credit has been pretty pronounced. Rajeev, yes, let me turn to you. If you were an investor and you'd bought Magnificent Seven in April during the peak volatility, you'd be up 30%. If you bought NVIDIA since mid-April, you'd be up 40%. I guess maybe the takeaway here is, and you can respond as you see fit, but don't underestimate U.S. tech.
Well, thank you for having me first, and give a little context on One Investment Management. We don't invest in liquid assets. We do more private investing. And I did that for 10 years as CEO of the Vision Fund before that. So we don't take short-term views on where the markets are going. We were long NVIDIA when it was a $30 billion company in 2017, our biggest position in the Vision Fund. And now in One Investment Management, I believe, as Katie said, there will be volatility. The market is priced to not perfection. There is enough risk premium. We have positive real rates. Inflation is at 2% and 10-year treasuries are at 4.5%. So the US, if you go back last 10 years, had negative real rates. So you're getting paid for taking risk. But you have to look at kind of the macro environment and say, where are the dislocations? As I was listening to Howard Marks before me, been reading him for 20 years. How should you be positioned is important over the next 12 months. It'll be volatile. It'll be anything but boring, okay? Go in where there is structural deficit of capital. What's happening in the US, if you look at US, Europe, the large economies, the liquid markets, you have thousands of regional banks who have withdrawn capital because of rising rates. And rates, they were hoping that rates will come down and bail them out in 2025. That's not happening. So their books are still underwater with 2% loans. So the regional banks are not players in the US, which is by any day the largest market to invest in. Hence, there are plenty of opportunities to fill that capital gap with providing capital to different asset classes, real estate, construction, of housing. There's a structural deficit of houses in the US. To corporates, middle market corporates, to growth companies. It doesn't have to be NVIDIA or Microsoft. And the last thing I can talk about is predicting markets as to where it's going to go. There's a lot of retail hype and froth in the market too, with a lot of people who made easy money in 2024 spending a disproportionate amount of time becoming investors and trading electronically. But my advice would be keep enough capital aside. There will be dislocations, and be patient a couple of times a year and take advantage of that. When there was a dislocation in April, we looked at what could we buy that might have mark-to-market volatility with price, but won't lose money even if a 2008 happens. And there were triple B CLOs, double B CLOs, other liquid structured assets that we knew might go down another 10 points, but won't lose money over the next 4 years. And they traded extremely cheap. And you could buy $1 billion of those.
Yeah. Let me ask you about artificial intelligence and whether you think investors are sufficiently discounting how disruptive artificial intelligence is going to be to our lives.
No, we're sleepwalking into the disruption. So,
we're sleepwalking into disruption.
Correct. Because, and the generative AI right now are the large ALM models, OpenAI and others, and that's just the foundation stone, but it is moving fast. If you look at last week's news, Microsoft laid off thousands of software programmers across the globe, India, US, in Seattle. And you would think, if you went back last 5 years, and I am a member of the board of the UPenn advisory board, of the 400 undergrads who came in to study engineering at Penn, 80 100, 120 would do computer science. Nobody wanted to do mechanical engineering and so on. So, but that's not the issue. Every white-collar job which is process-driven, what generative AI is good at is it has become good at answering questions. It's not good at, you still need Katie to ask the right questions.
By the way, that's what I say to my kids when they go to school every morning. Ask good questions.
Yeah.
Humans still have to do that. I agree with that.
But to give an answer, they have processed every book in the world, every data in the world. So they are 1 million times more information than a human being can ever hold. So they can answer the question. So it now takes weeks to process a mortgage application, an insurance claim, medical claims, even in asset management will get disrupted. When we do lending, and if you go to a large alternative asset managers today, there are hundreds of people monitoring loans, monitoring assets, risk managing, so on. The computer will do an amazing job and bring down costs dramatically, bring efficiency in. Asset management, and Katie, as Katie would tell you, is a scale business. But scale may not be that essential anymore if it's generative AI, because the cost of doing business will come down dramatically. So the punchline is there are tens of thousands of businesses, mid-cap, small businesses, others. And when we invest equity or lend to them, we look at their last 5 years of financials. What is the free cash flow, EBITDA, profits, how much debt can they bear, what should be the equity value? But that need not be the next 5 years, because they will get disrupted. Because if you're a company that's processing mortgage claims, that's processing medical claims, that's doing actuarial work, aircraft leasing, what have you, which are human, white-collar, intensive jobs, the computer will do it better.
Katie, the thesis of America Inc. outperforming the rest of the world got tested in the last couple of months. And you see it in the performance of some of those key financial assets. There has been a recovery of sorts, as we just spoke about. How are you thinking about investing in the US versus the rest of the world right now?
So I think, just breaking this down, there's this topic currently about US exceptionalism and whether it's been permanently damaged and whether that's going to alter the risk premia. And so I want to kind of just say like what my view on what US exceptionalism means, and then I'll talk about how we invest around that. So I think there are kind of 5 factors that have made the US a really exceptional place post-World War II. The first is that we had very strong alliances. The second is, very quickly, an act from 1950 called the National Science Foundation Act, which, making it short, was just connecting research dollars from universities into the private sector. That has given rise to a lot of the technologies that Rajeev just talked about. Third would be the exorbitant privilege of being the world's reserve currency. Fourth would be rule of law and constitution. And fifth would be demographics, that as a country, we in theory can tap into 7 billion people, whereas China, the world's second largest economy, has a smaller pool to come from. That's historically been true. I think we could argue we're taking all of those out for a little bit of a test drive right now. But ultimately, I think while some of those formidable advantages are bendable, they're probably not breakable. However, I think both things can be true. I think the US can remain exceptional, and I think it's still possible that investors are going to look to allocate marginal dollars elsewhere. And I'm going to complete that thought, and if we get a second, I want to say something on AI. And what I mean by those marginal dollars is the following. Like, there's a lot of talk about whether we're losing or we're winning. I just want to posit to people that the United States of America has 5% of the world's population, 25% of its GDP, and over 70% of its market cap. So we came into 2025, one might argue, with actually a lot to lose. And I really dismiss the concept that people would allocate away from the US in January. I just said, that's not possible. We are the world's reserve currency. We have all these formidable advantages. There's nowhere better to allocate capital. I actually still think that's true. And the middle market, which you talked about, is, if you add it together in the US, the third largest economy in the world. So, I mean, there are amazing opportunities. But what I'm hearing from investors all over the world is, yeah, America's great, and it may stay great, but maybe I don't need to put more than 70% of my capital into that equity market. The UK pension market currently has 12% of its assets in 7 companies that are American. So I just think a little bit of the disruption and chaos has made people look at the portfolios and say, maybe we would, benefit from some diversification. And I'll end by saying a place in this region that we actually are seeing a lot of interest is in emerging market debt as an example, which has actually outperformed, as has Europe, the US in debt markets, surely, and in equity markets as well, in the case of Europe. But back to emerging market debt, half of that index is investment grade. So you have a lot of people, a lot of LPs looking at that and saying, do I want to be with the US IG credit facing tariffs and slowing economy? Or might I be with an IG credit in emerging markets where I can get similar or higher spread? Look at this country, in Qatar. You have a good quality credit that's actually deleveraging. So I just think people are open to the benefits now of diversification.
Yeah.
And can I just say one thing on AI before? Do you mind if I wanted to make one comment on what you said? Because there was a chart up before about the Mag 7, and have so much more experience in technology investing than me. But one thing I wanted to say, when we look at the future of AI, and we've had a dedicated AI fund for 10 years, I completely agree with what you said. Currently, we have like 70% in the infrastructure, which, by the way, was money losing for the internet. So time will tell. Like, we think this is different. We should argue that. But we have 20% in the software and 10% in what I would call the adapters to it. And I think that's going to shift a lot. And we agree that the winners are going to be the companies that figure out how to adapt themselves. This is a very important point. It might be real estate. It could be industrials. It might be hospitals that could be the winners of that revolution.
Financial services. A lot of industries need to be disrupted. So agentic applications of AI over the next 5 years is where the fun will be.
Yeah.
The companies that apply generative AI.
I want to ask you about a sort of parallel theme, because data centers require a lot of power, a lot of energy. And what has happened in the last year or so, the last 6 months, is the hype around energy transition, around ESG, has fizzled out. But when I speak to people, especially in this part of the world, when they talk about investing in data centers, they tell me a lot of that is actually going to be powered by renewable energies, by potentially nuclear energy. Is that going to give the energy transition basket another push?
Absolutely. And the push for green was good. We will need a lot of energy for many reasons. Data centers, we have 8 billion people on this planet, and of which 3 billion are becoming affluent in India, Southeast Asia, China, and in Africa, whose per capita consumption of energy is going to go up as they become affluent. So the demand for energy is going to go up dramatically, not just because of data centers, but because of human demand for energy also. They're going to fly more, they're going to consume power more. And hydrocarbons will always be important, and there are cleaner forms of hydrocarbons, like natural gas. But to me, the cleanest energy source always, there is hydrogen, there are other technologies, it was always nuclear. And I have seen quite a few companies, without naming names, who are doing small-scale modular reactors, SMRs, which require 5 acres of land. One SMR produces 320 megawatts. So if you put 2 SMRs, they're underground, so even if there's an accident, there is no spillover. The time from start to finish takes 3 years to put a plant together. It doesn't take multiple years with a lot of resistance from the neighbors, etc. It can be in the middle of nowhere where there is a grid. And so 2 SMRs with 650 megawatts can fire data centers and so on. So I see by 2029, the first SMRs coming on steam and producing energy, and there'll be thousands of SMRs in the 2030s, which will fuel and kind of fill the gap for the energy shortage that is.
Interesting. Katie, I want to ask you about private credit. You touched on it briefly at the beginning, at the start, and there's so much interest and so much money going into that space. Is it becoming more difficult to find opportunities?
I do think it is. First of all, I really appreciate Rajeev's endorsement for the asset class. And if private credit's like...
That's what we do for a living.
Endorse asset classes?
Yeah. Well, and allocating, but also just, you've been very prescient on and getting lots of the parts of the technology market right. So I appreciate your endorsement of the exciting U.S. middle market. And we do think that there are opportunities there. You asked if it's getting crowded. I do think there are parts of private credit that are getting crowded. There is some optimistic lending happening in the large cap sponsor space, with a lot of money probably chasing too few deals. And so my advice to everybody in the audience is to be looking for unique sources of origination. This is very important. Like, what is the origination edge? This is why we've done a JV with PNC Bank, which is the #4 middle market lender in the US. It's to get unique origination with less dollars chasing the deals. I would also say, in private credit, the covenant is the asset class. It is the thing that made it different from liquid QSIP credit. And a lot of the market has given that covenant away. So you really want to push your managers on what is the underwriting, do they have strong covenants, and if we do have a business cycle, which we think we're going to get, do those covenants and does that documentation give them the ability to get to the table to work out on your behalf? And do they actually have experience of working out on your behalf? Because our view is we are going to eventually get some business cycle. And 90+% of private credit managers started post-GFC. So they've invested in a very benign environment for credit. And we would argue that things are getting rockier. And let me just end by saying, picking up on something that Rajeev pointed out earlier, which is finding out where there are gaps in the market, where capital's scarce. We think one of the best opportunities right now, really for looking out the next 10 years, is in rescue finance in parts of the US middle market. So even in the absence of a business cycle, you have companies with upside down capital structures put in place by private equity post-COVID, and a third and rising of our market cannot even cover its fixed interest charges. So you can go into those companies, get a high current coupon, get PIK, get warrants to be an equity holder. This is where the returns are in the complex and highly structured part of this market.
That's a great place to leave it. Rajeev, one more. Yeah, go on.
Let me finish on private. What is important, whether it's private credit or any private asset, is be solution driven. Don't go into a situation which is competitive, where five lenders are bidding to lend them money. Then you have no competitive edge. Yeah. Be solution driven, provide solutions to, and it doesn't have to be corporates. Private credit can be asset based, aircraft financing, shipping finance, leasing, real estate construction for homes, lending to corporates. Give them a solution where they're not able to find a willing lender. If it's 5 lenders vying to lend to them, back off.